Johnson?
Yeah, what's going on?
For nearly 15 years, Marcus Johnson was a trusted lending manager with access to millions of dollars in loans and sensitive accounts. But when a routine audit uncovered suspicious transactions, investigators uncovered a fraud scheme worth nearly $8 million.
Step away from your desk and keep your hands visible.
In the financial industry, trust is often treated as a form of currency. Members trust institutions with their savings, their homes, their businesses, and in many cases, their futures. Few places embodied that trust more than Riverside Community Credit Union, a mid-sized financial institution located along West Jefferson Avenue in Columbus, Ohio. Serving nearly 30,000 members across central Ohio, the credit union had spent decades building a reputation for stability, personal service, and conservative lending practices. For many members, the credit union wasn't just another bank. It was where first-time homebuyers secured mortgages. It was where local business owners applied for startup loans. It was where retirees deposited pension checks they had spent decades earning. Employees understood that reputation carried enormous responsibility. Among those employees was Black Marcus Johnson. At 48 years old, Marcus had spent nearly 15 years working inside the institution. Personnel records described him as dependable, knowledgeable, and exceptionally familiar with lending operations. Colleagues remembered him arriving early, usually before most staff members entered the building. By 7:15 every morning, the glow of his office computer could often be seen through the glass walls overlooking the lending department. His path through the organization appeared straightforward. Marcus started as a loan processor in 2010. Former supervisors described him as detail-oriented and eager to learn. Internal performance reviews consistently reflected strong ratings. He rarely received disciplinary write-ups. He completed advanced compliance training. He volunteered for additional certification programs. Each year seemed to bring another promotion. By 2018, Marcus had become one of the most influential figures in the credit union's lending division. Co-workers frequently sought his advice when dealing with unusual applications or complicated underwriting questions. Younger loan officers viewed him as a mentor. Senior executives trusted his judgment. During quarterly leadership meetings, his name often appeared alongside discussions about operational efficiency and loan growth targets. On paper, he represented exactly the kind of employee organizations hope to retain. That trust translated into access. As lending manager, Marcus oversaw millions of dollars in active loans. He supervised approval workflows, monitored high-value applications, and possessed elevated system credentials unavailable to most employees. Internal software logs allowed him to review sensitive borrower information, authorize exceptions, and approve certain transactions that would normally require additional review. The authority wasn't unusual for someone in his position. What mattered was how much the institution depended on that authority functioning honestly. Inside the lending department, daily operations followed predictable routines. Phones rang constantly. Printers produced stacks of loan disclosures. Employees moved between cubicles carrying folders thick with financial documents. Overhead fluorescent lights reflected against computer monitors displaying credit, reports, income statements, and underwriting software. It was a workplace built on procedures, and procedures are only as reliable as the people enforcing them. For years, nothing seemed out of place. Then small details began appearing. A loan officer reviewing a commercial application noticed an approval had moved through the system unusually quickly. The file involved incomplete documentation that normally would have triggered additional review. When she asked about it, she was told Marcus had personally authorized the exception. The explanation seemed reasonable. After all, Marcus understood lending policy better than almost anyone in the building. A few weeks later, another employee encountered a similar situation involving an expedited approval. Again, Marcus's authorization appeared in the system records. Again, nobody raised formal concerns. The transactions weren't obviously fraudulent. They were simply unusual. And unusual behavior often gets overlooked when it comes from trusted employees. Months passed. Small discrepancies occasionally surfaced during internal reviews. Minor documentation inconsistencies, missing supporting forms, approval timelines that appeared slightly out of sequence. Nothing large enough to trigger an investigation. Nothing significant enough to justify accusing a respected manager of wrongdoing. Most employees assumed there was an explanation. Some believed the discrepancies resulted from software updates. Others attributed them to administrative errors. A few quietly wondered whether operational shortcuts were becoming too common. Nobody pushed the issue. The lending department remained busy. Loan volume remained strong. Executive leadership continued praising departmental performance. The institution kept moving forward. Then, in early spring of 2025, a routine compliance review introduced the first development. Investigators would later identify as critically important. The review itself wasn't unusual. Every quarter, auditors examined a sample of loan files to verify adherence to policy requirements. The process was methodical and largely uneventful. Most findings involved minor corrections and procedural reminders. But this review produced something different. One auditor noticed a discrepancy involving borrower documentation attached to a recently approved loan. At first glance, it looked like a simple clerical mistake, the kind of error that happens when paperwork moves between departments. The auditor flagged the file for clarification and continued working. Hours later, a second file revealed a similar inconsistency, then a third. The details weren't identical, but the pattern felt familiar. As spreadsheets accumulated across conference room tables and auditors compared records, under the hum of fluorescent lighting, questions began emerging that nobody inside Riverside Community Credit Union had anticipated, because what initially appeared to be a simple bookkeeping error would soon expose a pattern no one could explain. The questions raised during the initial review did not disappear when the auditors left the DeGraft. If anything, they became more difficult to ignore. At Green Valley Animal Rescue, located on East Ridge Parkway outside Springfield, Missouri, financial reporting was usually routine. Quarterly board meetings focused on adoption rates, veterinary expenses, volunteer recruitment, and fundraising performance. Most board members were volunteers themselves. They weren't forensic accountants. They were local business owners, retired professionals, and longtime animal advocates donating their time. One of those volunteers was Karen Mitchell, a 62-year-old retired bank manager who served on the shelter's finance committee. In July of 2024, Karen sat at a folding table in the shelter's administrative building reviewing quarterly reports before an upcoming board meeting. Around her, the sounds of the shelter continued as normal. Dogs barked from the kennel wing. Phones rang intermittently. An aging copier hummed in the hallway. At first, nothing seemed unusual. Then she noticed a number that didn't make sense. According to public fundraising materials, the shelter's spring rescue campaign had generated nearly $184,000 in donations. The campaign had been heavily promoted on social media. Local news stations covered the event. Donors had contributed specifically toward emergency medical treatment and rescue operations. But the available operating balances appeared lower than expected. Karen initially assumed she had overlooked something. She reviewed the spreadsheet again, then a third time. The numbers still failed to align. The discrepancy wasn't large enough to immediately suggest theft. It looked more like a bookkeeping issue, a delayed deposit, a reporting error, a transfer waiting to clear. Still, she made a note and moved on. The problem was that similar discrepancies kept appearing. Over the next several days, Karen began comparing fundraising reports with internal financial statements. The more documents she reviewed, the more inconsistencies she found. Certain donations appeared prominently in public fundraising summaries but seemed absent from the accounts designated to receive them. Some grant awards could be traced into shelter records. Others appeared to stop halfway through the accounting trail. By August, members of the Finance Committee quietly requested additional documentation. The request wasn't accusatory. They simply wanted clarification. That responsibility ultimately landed with Black employee Denise Carter. As executive director, Denise oversaw daily operations and maintained significant influence over financial administration. She had become the public face of the shelter. Local donors trusted her. Volunteers admired her commitment. Board members viewed her as the person most capable of explaining complicated funding questions. When Denise attended the committee meeting, witnesses later described her demeanor as calm and prepared. She reviewed several reports and offered straightforward explanations. Some donations, she said, had been temporarily classified under alternative accounts while awaiting allocation decisions. Certain grants were still undergoing reimbursement processing. A few transfers involved routine bookkeeping corrections. The explanations sounded reasonable. Most board members accepted them. The meeting ended without major confrontation. But afterward, Karen remained uneasy. Years of banking experience had taught her that accounting errors typically create isolated Mary. What she was seeing felt different. The discrepancies appeared repeatedly, often involving specific categories of donation funds. That detail would later become important. Over the following months, finance staff began receiving increasingly specific requests for records, bank deposit reports, fundraising receipts, vendor payment histories, grant documentation, electronic transfer records. As paperwork accumulated, patterns slowly emerged. Some deposits appeared delayed for unusual periods before entering shelter accounts. Certain transfers moved through internal classifications that employees struggled to explain. Several accounting entries contained revisions that lacked supporting documentation. None of these discoveries proved misconduct. Individually, each could be explained away. Together, they became harder to ignore. Employees also began sharing observations investigators would later revisit. One accounting clerk recalled receiving instructions to recategorize donation funds shortly before monthly reports were generated. Another employee remembered questioning a transfer involving a veterinary emergency fund. According to interview notes, the employee received a brief response. "That's already been handled. Just process it." The explanation seemed sufficient at the time. Months later, it sounded different. As concerns increased, board members authorized a more detailed financial review. The atmosphere inside the shelter began changing. Conversations became quieter. Administrative staff noticed closed-door meetings among finance committee members. Questions that once received quick answers now required additional documentation. Meanwhile, Denise continued assuring leadership that the issues stemmed from reporting, delays, and accounting adjustments. Publicly, operations appeared normal. Animals continued arriving. Adoptions continued. Fundraising campaigns continued generating support. Behind the scenes, however, auditors were beginning to compare records line by line. The first major breakthrough came when reviewers attempted to reconcile donation receipts with actual bank deposits. Several large contributions could be verified through donor records. The donors existed. The checks existed. The fundraising acknowledgments existed. What investigators struggled to find were corresponding deposits entering the expected shelter accounts. The discovery changed the tone of the review. What began as administrative concerns started looking like a financial control problem. Soon afterward, investigators identified unusual transfer activity involving restricted rescue funds. Then they discovered accounting entries that had been modified multiple times. Then they noticed authorization approvals connected to the same small group of administrative users. Each new finding built upon the previous one. Missing deposits, unusual transfers, altered accounting records, repeated approval patterns. The evidence wasn't complete, but it was growing. And for the first time, some board members began considering a possibility they had spent months avoiding. What if the discrepancies weren't mistakes? What if someone inside the organization was intentionally moving money? The question hung over every subsequent meeting, because as auditors continued tracing transactions through years of records, they discovered the inconsistencies were not limited to a single fundraising campaign. They weren't limited to a single account, and they weren't limited to a single year. The deeper auditors dug into the records, the more rescue money seemed to disappear without explanation. The realization that the discrepancies stretched across multiple years changed the entire investigation. What had begun as an internal financial review was now becoming a forensic reconstruction. By October of 2024, Green Valley Animal Rescue had retained an outside accounting firm specializing in nonprofit fraud examinations. Investigators arrived carrying laptops, portable scanners, and years of archived financial records. Temporary workstations were assembled inside a small conference room near the shelter's administrative offices. The room quickly filled with banker boxes, transaction ledgers, donor reports, and printed bank statements. The objective was simple: follow the money. The process was anything but simple. Forensic accountants began reviewing every major donation account maintained by the shelter over the previous 5 years: emergency rescue funds, veterinary treatment funds, rehabilitation initiatives, special fundraising campaigns, restricted donations designated for specific medical procedures. Every dollar was supposed to leave a trail. Investigators intended to find it. The first several weeks produced frustratingly little progress. Transfers appeared legitimate at first glance. Documentation often existed. Approval signatures were present. Account balances appeared internally consistent. But when investigators compared transactions across multiple systems, inconsistencies emerged. Money was moving. The question was where it ultimately ended up. As spreadsheets expanded across multiple monitors, accountants began constructing transaction timelines. Electronic banking logs were compared against internal accounting software. Grant records were matched against deposits. Donation receipts were reconciled with withdrawals. Patterns slowly emerged. Several transfers originating from restricted rescue accounts were routed through intermediary operating accounts before disappearing into broader administrative categories. On paper, the transactions appeared ordinary. In practice, they became increasingly difficult to explain. The same account classifications appeared repeatedly. The same approval pathways appeared repeatedly. And one name appeared repeatedly. Black employee Denise Carter. At this stage, investigators still avoided conclusions. Experience had taught them that financial irregularities often looked suspicious before reasonable explanations emerged. They continued gathering evidence. Then the bank records arrived. Those records became one of the most important developments in the entire investigation. Subpoenaed account histories revealed that certain transfers did not simply disappear after leaving shelter accounts. Instead, investigators identified a sequence of intermediary movements. Money left restricted donation funds. It entered secondary accounts. Those funds were then transferred again. Eventually, portions of the money appeared in accounts connected to Denise. The discovery immediately elevated concern, but investigators remained cautious. Financial relationships can be complicated. Authorized reimbursements, payroll adjustments, vendor payments, and legitimate expense reimbursements can all create unusual transaction paths. The records alone were not enough. They needed context. That search led investigators deeper into electronic records. Banking login histories showed repeated access to financial management platforms during unusual hours. Several transactions were authorized late at night or during weekends when administrative offices were closed. Computer logs indicated those authorizations frequently originated from devices assigned to Denise's office. Security records provided additional information. Electronic keycard reports showed after-hours entry into the administration wing on dates corresponding with several questioned transactions. The logs did not prove wrongdoing, but they established opportunity. As evidence accumulated, investigators expanded their timeline. Months became years. Years became hundreds of transactions. Each new document added another layer. Email records soon became equally important. Thousands of messages were reviewed. Most were routine workplace communications involving adoptions, fundraising events, volunteer schedules, and veterinary coordination. A smaller number drew attention. Several emails referenced urgent fund reallocations that lacked supporting documentation. Others instructed staff to process transfers before month-end reporting deadlines. In some cases, employees asked clarifying questions. Responses were often brief. Handle as discussed. Process under administrative allocation. I'll update the records later. Individually, the messages appeared harmless. Together, they suggested an unusual level of control over financial reporting. Investigators also began interviewing current and former employees. Those interviews revealed a different side of the story. One former veterinary coordinator described repeated budget restrictions despite successful fundraising campaigns. According to interview summaries, staff were routinely told emergency treatment funds were limited. Expensive surgeries required additional approval. Specialized procedures were often postponed. Requests for outside specialists were sometimes denied altogether. The explanations always sounded financial. There wasn't enough money. Resources were stretched. The shelter had to prioritize. Former employees remembered accepting those explanations. At the time, they seemed reasonable. Now investigators were comparing those claims against records showing hundreds of thousands of dollars flowing through restricted accounts. The contradiction was impossible to ignore. Several witnesses described specific cases that continued haunting them years later. One involved a severely injured German Shepherd rescued from a roadside ditch. Veterinary staff recommended a costly orthopedic procedure. The treatment estimate exceeded $8,000. According to employees, they were informed that emergency rescue funds were insufficient. The surgery was delayed, while additional donations were sought. Another case involved a young Labrador requiring neurological treatment following severe abuse. Again, funding concerns were cited. Again, treatment decisions were delayed. Investigators never claimed those outcomes were directly caused by missing money. But the stories transformed the case. The focus shifted. This was no longer simply a discussion about accounting entries and spreadsheets. Donors had contributed money believing it would help vulnerable animals. Volunteers had organized fundraising events believing resources were reaching their intended purpose. Staff had made difficult medical decisions, believing funds were unavailable. The emotional weight of the investigation changed, and so did public perception. As forensic analysis continued, estimated losses increased. Initial concerns involving tens of thousands of dollars grew into hundreds of thousands. Each accounting period revealed additional unexplained transfers. Each year uncovered new discrepancies. Investigators became increasingly convinced they were not looking at isolated errors. The evidence suggested repetition, consistency, method, a system. The strongest indication emerged when accountants mapped transaction activity against authorization records. Again and again, questioned transfers traced back to approvals linked to Denise's administrative authority. The pattern became impossible to dismiss as coincidence. Yet investigators still needed something stronger, a direct connection, a transaction capable of tying together years of missing funds. Weeks later, while reviewing a sequence of transfers buried within thousands of pages of banking records, investigators found exactly that. It was a single transaction, small enough to avoid attention, specific enough to expose the entire structure, and it would soon become the piece of evidence that connected every missing dollar to a single decision-maker. The transaction investigators identified did not immediately trigger criminal charges. Instead, it triggered panic inside the organization. By January of 2025, members of Green Valley Animal Rescue's board of directors were meeting behind closed doors several times each week. Financial reports that had once occupied a few minutes of discussion now dominated entire evenings. Conference tables filled with spreadsheets, audit summaries, and transaction timelines. Printed bank records sat stacked in cardboard file boxes along the walls. The atmosphere had changed completely. Board members who had spent years focused on animal welfare were now confronting the possibility that the organization itself had become the source of a major crisis. Outside accountants continued tracing funds. Attorneys reviewed governance policies. Insurance representatives requested documentation. And throughout the process, Black employee Denise Carter remained at the center of nearly every significant finding. The board moved carefully. They understood the reputational consequences of acting too quickly. They also understood the risk of doing nothing. Eventually, they reached a decision. Denise would be placed on administrative leave pending the outcome of the investigation. The action was carried out quietly. There was no public announcement, no press conference, no dramatic confrontation. According to employee interviews, Denise arrived at the shelter one morning, expecting a routine workday. Instead, she was informed that outside investigators required unrestricted access to administrative records and financial systems. Witnesses described a brief meeting inside a small office near the executive wing. The conversation reportedly remained professional. Denise denied wrongdoing. Board representatives avoided direct accusations. By the end of the meeting, her building access had been suspended. For the first time in nearly a decade, she was no longer running the shelter. News of the leave spread almost immediately. Employees talked. Volunteers talked. Former staff members called one another. Within days, rumors began moving through local rescue networks across Springfield and neighboring communities. Most people did not know the details. They only knew something serious was happening. That uncertainty became its own problem. The shelter depended heavily on public trust. Donations fueled daily operations. Community goodwill supported fundraising events, emergency rescues, foster programs, and veterinary partnerships. As rumors spread, confidence began to erode. Donors started asking questions. Volunteers requested explanations. Partner organizations sought reassurance. Leadership struggled to provide answers because investigators were still gathering evidence. The silence created a vacuum. Speculation quickly filled it. Local media became aware of the situation shortly afterward. The first stories were cautious. Reporters described an ongoing financial review and confirmed that the executive director had been placed on leave. The coverage initially remained limited, but each new development generated additional attention. Television stations requested interviews. Newspapers filed public records requests. Online discussion groups dedicated to animal rescue began sharing allegations and theories. The story was no longer confined to board meetings and accounting reviews. It had become public. Inside the shelter, operational problems intensified. Employees described the following months as some of the most difficult in the organization's history. Emergency spending restrictions were implemented almost immediately. Departments were instructed to reduce expenses wherever possible. Purchase approvals required additional review. Routine expenditures faced delays. The shelter's financial uncertainty affected nearly every area of operation. Vendor payments became increasingly inconsistent. Several suppliers reported delayed invoices. Veterinary providers began requesting updated payment assurances before authorizing certain services. Shelter managers found themselves spending valuable time negotiating payment schedules instead of focusing on animal care. Staffing problems soon followed. Hiring freezes prevented vacant positions from being filled. Employee turnover increased. Remaining staff members absorbed additional responsibilities. Long shifts became common. Morale deteriorated. Workers who had joined the organization because they cared about animals now found themselves answering questions about financial misconduct. The emotional toll became increasingly visible. Investigators continued uncovering new information. What initially appeared to be questionable transactions evolved into evidence of broader control failures. Audit reports identified repeated violations of basic financial safeguards. Documentation requirements were frequently bypassed. Approval procedures were inconsistently enforced. Restricted funds were transferred without adequate oversight. Record-keeping practices varied significantly depending on the account involved. Many of these failures had existed for years. The investigation revealed a troubling reality. The shelter's financial system depended heavily on trust rather than verification. Denise had accumulated substantial authority over both operations and finances. Board members relied on her reporting. Employees relied on her guidance. Donors relied on her public statements. Very few people independently verified the information flowing through the organization. That level of trust created vulnerability. Investigators discovered that board financial reviews often relied on summary reports rather than underlying records. Independent audits occurred infrequently. Financial transparency standards remained inconsistent. Internal monitoring procedures were often informal. No single failure caused the crisis. Multiple weaknesses combined over time. The result was an environment where warning signs could remain unnoticed for years. As details emerged, community reaction shifted from confusion to anger. Many donors felt personally betrayed. Some had contributed specifically to emergency medical campaigns promoted through emotional rescue stories. Others sponsored rehabilitation programs for abused animals. Several donors told reporters they remembered writing checks after seeing photographs of injured animals requiring treatment. Now they were learning that investigators questioned where portions of that money had gone. Volunteer frustration became equally intense. Many had donated thousands of hours cleaning kennels, transporting animals, organizing fundraisers, and supporting adoption events. For them, the allegations represented more than financial misconduct. They represented a violation of the mission itself. The shelter existed to protect vulnerable animals. The investigation suggested that trust may have been exploited. As outside accountants continued reviewing records, estimated losses continued growing. Each new batch of documents seemed to produce additional questions. Each answer led to another discrepancy. Each discrepancy pointed investigators back toward the same collection of approvals, transfers, and administrative decisions. By spring, the emotional atmosphere surrounding the case had fully transformed. Suspicion had become shock. Shock had become outrage. And outrage was beginning to produce demands for accountability. Investigators, meanwhile, were assembling the final pieces of a case that had grown far larger than anyone initially imagined. By the time authorities were ready to act, the evidence had become impossible to ignore. The decision to pursue criminal charges came after months of audits, interviews, and forensic analysis. By the summer of 2025, investigators believed they had assembled a timeline detailed enough to explain not only where the money had gone, but how it had moved through the shelter's financial system without detection. What remained was the confrontation. According to investigative records, authorities arrived shortly after 8 a.m. on a Tuesday morning. The parking lot outside Green Valley Animal Rescue was already beginning to fill, with employees, volunteers, and veterinary staff arriving for their shifts. Most had no idea what was about to happen. Several investigators entered the administrative building, carrying document cases and evidence collection equipment. Others remained outside. The operation was calm, organized, and procedural. Search warrants had already been approved. The objective was evidence preservation. Computers were photographed before being disconnected. Office desks were documented. Filing cabinets were opened and cataloged. Mobile devices, external hard drives, accounting records, donor correspondence, and archived financial files were collected. Employees watched quietly from hallways and office doorways. Some later described an atmosphere of stunned silence. Others recalled hearing only the hum of fluorescent lights and the occasional bark from the kennel wing as investigators moved through the building. Black employee Denise Carter arrived shortly after the operation began. Witnesses reported that she initially appeared confused. Investigators informed her of the warrants and requested access to several devices and records. The exchange remained professional. No raised voices, no dramatic confrontation. According to later testimony, Denise denied intentionally misusing shelter funds and insisted any discrepancies would ultimately be explained through accounting reviews. Investigators listened. Then they continued collecting evidence. Several hours later, Denise was formally taken into custody. The charges included theft, fraud, embezzlement, and misuse of charitable funds. News of the arrest spread almost instantly. Local television stations interrupted regular programming with breaking updates. Online news outlets published photographs of investigators carrying evidence boxes from the shelter. Social media pages dedicated to animal welfare exploded with reactions. For many community members, the arrest felt impossible. Denise had spent years representing the shelter in fundraising campaigns, adoption drives, and public outreach events. Now she was being accused of diverting money intended for rescued animals. The contrast was difficult to process. Within days, prosecutors publicly outlined the allegations. Court documents described a pattern of transfers allegedly moving restricted donations through intermediary accounts before ultimately benefiting Denise. Authorities emphasized that the charges remained allegations. Still, the details were alarming. Media coverage intensified. Court hearings attracted local reporters, former volunteers, donors, and curious residents. By the time preliminary proceedings began, the case had become one of the most closely watched public corruption investigations in the region. The courtroom itself was relatively ordinary. Wood-paneled walls, rows of worn benches, the soft scrape of chairs against tile floors, the steady rhythm of clerks processing documents. Yet inside that room, years of financial records would be dissected transaction by transaction. Prosecutors began with the paper trail. Forensic accountants testified about thousands of pages of banking records reviewed during the investigation. Jurors were shown transaction summaries, account histories, and transfer timelines. Complex financial movements were converted into visual charts designed to simplify years of activity. According to the prosecution, the evidence revealed repeated movement of restricted donations through multiple accounts before funds disappeared from their intended purposes. Electronic transfer histories became central to the case. Investigators walked jurors through specific transactions, dates, amounts, authorization records, approval sequences. The goal was to demonstrate a pattern rather than isolated mistakes. Defense attorneys challenged those conclusions aggressively. They argued that nonprofit accounting can be complicated, particularly in organizations managing grants, reimbursements, and restricted donations. Several questioned transactions, they argued, reflected bookkeeping corrections rather than criminal intent. Others resulted from administrative errors made by multiple employees over several years. The defense repeatedly emphasized one theme: poor accounting was not necessarily fraud. That argument created some uncertainty. Then prosecutors introduced additional evidence. Email communications recovered during the investigation revealed repeated instructions regarding fund transfers, account classifications, and reporting adjustments. Most messages appeared ordinary when viewed individually. Together, prosecutors argued, they revealed an effort to control how financial information was recorded and presented. Jurors reviewed message chains spanning multiple years. Several included questions from employees seeking clarification. The responses often directed staff to process transactions without extensive discussion. The prosecution argued these communications helped explain why questionable transfers received little scrutiny at the time. Witness testimony added another layer. Board members described their reliance on financial reports provided by leadership. Several admitted they rarely reviewed underlying documentation. They trusted summaries. They trusted internal explanations. Most importantly, they trusted Denise. Former employees echoed similar themes. One finance clerk described processing transactions she did not fully understand because she assumed executive approval meant proper authorization had already occurred. Another recalled raising concerns about unusual account classifications only to be told everything had been reviewed. Donor testimony proved especially powerful. Several individuals described contributing specifically to emergency rescue campaigns, promoted through emotional fundraising appeals. One donor testified about contributing after seeing photographs of a severely injured dog requiring surgery. Another recalled donating to a rehabilitation fund intended to support abused animals recovering from neglect. Their testimony shifted the focus away from accounting terminology. The case became personal. The emotional impact deepened further when former shelter employees discussed treatment. Delays linked to alleged funding shortages. Veterinary staff described difficult conversations involving medical procedures that were postponed because resources were believed to be limited. Rescue coordinators recalled searching for additional donations, while assuming designated funds had already been exhausted. The courtroom grew noticeably quieter during those moments. The allegations were no longer simply about financial misconduct. They were about trust. Trust placed in an organization. Trust placed in a mission. Trust placed in a person. Throughout the proceedings, Denise maintained that she had not intentionally stolen from the shelter. Her attorneys argued the investigation relied too heavily on assumptions and retrospective interpretations of complicated financial records. They pointed to weak oversight, inconsistent accounting procedures, and years of administrative confusion. Those institutional failures were real. Even prosecutors acknowledged them. The difference was what each side believed those failures meant. By the time testimony concluded, jurors had heard from accountants, auditors, investigators, donors, volunteers, board members, and shelter employees. Together, their accounts painted a picture of an organization that had depended on trust for far too long. And according to prosecutors, that trust had been exploited. Yet as the case approached its conclusion, another question remained unresolved. Because the missing money was only part of the story. The final chapter would reveal just how much damage had been done beyond the missing money. The final phase of the case unfolded months after the testimony ended. By then, the courtroom crowds had become smaller. The television cameras that once filled the courthouse steps appeared less frequently. Public attention had shifted elsewhere. For those most affected by the scandal, however, the consequences remained very real. The sentencing hearing took place on a cold morning in late winter. Family members, former volunteers, shelter employees, donors, and members of the board quietly filled several rows of seats before proceedings began. The atmosphere felt noticeably different from earlier hearings. The debate over what happened had largely ended. Now the court would determine accountability. Black employee Denise Carter entered the courtroom wearing civilian clothing and carrying a stack of documents. Observers later described her demeanor as subdued and emotionally restrained. She spoke quietly with defense attorneys while waiting for the hearing to begin. Across the room sat many of the people whose trust had been at the center of the case. Some avoided eye contact. Others watched silently. When the judge reviewed the findings that supported sentencing, the focus returned to themes that had appeared throughout the investigation: misuse of authority, financial deception, failure of oversight, violation of public trust. Court records reflected years of questionable transactions involving funds intended for animal care, emergency rescues, and rehabilitation programs. Investigators had spent months reconstructing those financial movements. By sentencing, the transaction histories, audit findings, and forensic accounting analyses had become part of a detailed public record. The court also addressed restitution. Financial penalties were designed to recover a portion of the losses identified during the investigation. Attorneys discussed repayment obligations, asset reviews, and recovery procedures. No one in the courtroom seemed to believe the process would fully repair the damage. The money was only one part of the story. Victim impact statements made that reality impossible to ignore. Several donors addressed the court directly. One retired teacher described contributing regularly for years because she believed every dollar supported medical treatment for injured animals. Another donor recalled sponsoring emergency rescue campaigns after seeing social media appeals describing animals in desperate need of care. Their statements were not angry, they were disappointed. The emotion that appeared most often was betrayal. Many had trusted the shelter because they believed it represented something larger than itself, a mission, a purpose, a promise. That trust had been broken. Former volunteers expressed similar feelings. Several described spending weekends cleaning kennels, transporting animals, organizing adoption events, and staffing fundraising booths. They spoke about early mornings and long drives, cold weather adoption campaigns, emergency rescue transports, late-night veterinary visits. The work had always been difficult. They accepted that because they believed they were helping animals. The investigation forced them to question whether some of those sacrifices had been taken advantage of. One volunteer described the experience as losing faith in an organization she once considered family. The statement lingered in the room long after she finished speaking. The emotional damage extended beyond individual victims. The scandal had fractured trust throughout the local rescue community. Animal welfare organizations depend heavily on cooperation. Groups share resources, exchange information, coordinate adoptions, and assist one another during emergencies. After the allegations became public, many organizations reported increased skepticism from donors. Questions became more common. Requests for documentation increased. People wanted proof that contributions were reaching their intended destinations. The consequences spread far beyond a single shelter. In response, Green Valley Animal Rescue began implementing sweeping reforms. New leadership entered the organization with a clear objective: restore credibility. Independent audits became mandatory. External financial reviews were scheduled regularly rather than occasionally. Financial reports were expanded and standardized. Board members gained direct access to supporting documentation, instead of relying solely on executive summaries. Additional controls followed. Restricted donations could no longer be moved without multiple levels of authorization. Significant expenditures required dual approval. Electronic tracking systems were upgraded. Transaction records became easier to monitor and verify. Donation reporting procedures were redesigned to improve transparency. The shelter also introduced public accountability measures. Detailed financial summaries were published more frequently. Donors received clearer information regarding how funds were allocated. Governance policies were rewritten. Board training requirements increased. Committees responsible for oversight received expanded authority. Many of the reforms addressed weaknesses investigators had identified during the case: excessive trust, limited verification, poor transparency, insufficient oversight. The failures had not occurred overnight. Neither would the recovery. Rebuilding public confidence proved far more difficult than rewriting policies. Fundraising totals declined initially. Volunteer recruitment slowed. Community skepticism remained high. Potential donors frequently referenced the investigation before making contributions. The shelter spent years rebuilding relationships that had once been taken for granted. Gradually, progress emerged. New leadership emphasized openness. Financial information became easier to access. Independent reviews continued showing compliance improvements. Community support slowly returned. Not because people forgot what happened, because they wanted the animals to succeed despite it. The broader lessons of the case extended beyond Green Valley Animal Rescue. Charitable organizations often depend on goodwill and trust. Those qualities are valuable. They can also create vulnerabilities when accountability mechanisms fail. The investigation demonstrated how concentrated authority, weak oversight, and limited transparency can allow problems to remain hidden for years. No organization is immune. Even institutions built around compassion and service require verification. That reality became one of the lasting legacies of the case. For Denise, the outcome marked the collapse of a career that had once been defined by public trust and community support. For donors and volunteers, it marked the end of assumptions that good intentions alone are sufficient protection. And for the shelter itself, it became a cautionary example of how quickly credibility can disappear. In the end, the most striking contrast remained the simplest one. The organization existed to protect vulnerable animals. The allegations that brought down its director centered on resources intended for those same animals. That contradiction is what many supporters remembered most, because the money that vanished wasn't just funding. To many people, it represented abandoned animals, second chances, and lives that they believed they were helping save.